Dollar selling continues as Congress prepares to vote on massive tax cuts. The dollar is still under pressure and US Treasury yields are on the rise after President Trump headed to Congress to try and push through a tax cut package that could add between $3 and $5 trillion to the US federal debt. That's clearly making investors nervous about the country's $36 trillion total debt pile. Well, Laura Cooper is head of macro credit at Nuveen. Laura, we're seeing some market jitters about the size of US debt return this week. Why?
Well, I think the catalyst this week certainly was around the US downgrade that we saw late last week. And I think that wasn't really too much of a surprise given the fact that the US is on this unsustainable fiscal path. And I think the key question now is how much can Treasury yields rise further from here as we start to see investors increasingly price in the risk that we're going to potentially see ballooning deficits, higher debt to GDP ratios at a time when we're already seeing those interest service costs be quite elevated.
As you say, those longer dated Treasury yields are moving higher and higher. Are we seeing a wider move out of US assets from global investors here?
I think that's been the predominant story so far this year, but it's largely been one of equities. We've seen European equities be a predominant kind of gainer from some of that US uncertainty, not only from the policy side, but certainly looking at stretched valuations. I would say in the bond market, it's really too soon to say whether we're going to see a structural allocation shift away from the US government bond market. I think to our mind, yes, we're going to see some greater near-term uncertainty on the back or near-term volatility on the back of this uncertainty. But for the most part, the US Treasury market still remains quite deep and liquid. And we don't think that we are going to see kind of that ongoing rotation.
If those long-dated Treasuries are losing some appeal as a safe haven asset, where is the money going? What are investors choosing instead?
Interesting. When we look at kind of the data that we have so far, certainly through April, from a flow perspective, we are actually seeing foreign buyers. Yes, there is still demand for treasuries given some of the auctions, but we're actually seeing them rotate more into the corporate bond market in the US. This is reflective of the fact that defaults remain quite low. If we look at where yields are right now, it is quite a compelling opportunity to get that all-in income. And so I think that's a trend that is maybe surprising given the fact that the uncertainty emanating from the US and the fact that we are going to see a further deterioration in economic activity on the back of this ongoing trade war and uncertainty on the back of the fiscal dynamics.
When we last saw a spike in longer dated yields, it was noticeable that coincided with President Trump's administration dialing back some of the trade tension a bit. Do you think bond investors could further force the administration to change course?
Potentially. I think it all depends on the speed and magnitude of the moves that we see in the Treasury market. To our mind, I think investors will really be watching for whether there is any further escalation in that tariff rhetoric that they could punish the bond market. But even more importantly, it's around the tariffs that are implemented to date are much higher than what we've seen historically. That is going to feed into inflation. And as we start to see signs of that inflation pressure materialize, certainly before we see cracks in the economic growth, then I think investors are going to demand higher compensation for treasuries. And that does present a risk to our kind of year-end 10-year forecast for a 4.25% mark. If anything, we could see that drift higher. And certainly a wide range around that, given the volatility of uncertainty around these trade and fiscal developments.
With those trade talks with a number of other countries underway, is the administration trying to push the dollar lower as part of a bargaining chip here? Is what we're seeing in the currency markets partly the administration trying to push other countries to increase the value of their own currencies against the dollar?
That's a great question. I think the weaponization of the dollar is something that comes up quite frequently when I speak to investors, and potentially that is kind of a core of the objective of the US administration to have that weaker dollar. But I think in order for them to achieve that, we're going to need to see certainly the Fed cut rates more aggressively than what we are seeing elsewhere. And I don't think central banks outside of the US are in any position to raise their interest rates to create those kind of currency dynamics. So to our mind, we are going to see a very gradual depreciation from the dollar from here, largely reflecting prompting that reallocation of assets outside of the US, but not necessarily a catalyst that would prompt a swift depreciation and that would see other currencies, certainly like the euro, gain quite meaningfully on a near-term basis.
That was Cooper of Nuveen. Don't forget, you can watch more videos on Reuters.com.